Hey everybody, it's Eric Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with two very special guests, Amit Mukherjee of NEA and Kyle Doherty of General Catalyst. Guys, welcome to the podcast.
Thank you. Excited to be here.
Really excited. Thanks, Eric.
Awesome. So Amit, Kyle, I want to ask you guys both to introduce yourselves, how you sort of situate yourself within the investing world, how you think about your individual expertise. And then I want to start getting into your firms because General Catalyst and NEA are both enormous firms that have sort of different approaches to how they do venture. General Catalyst in the last few years has made a number of moves to scale and grow, and NEA has been one of the biggest franchises for quite some time. So I'm curious what your firms think differently about the world that has lent themselves to come to the conclusions that you guys have. Maybe Amit, we could start with you on an introduction and then move to you, Kyle.
I've been at NEA for almost my entire career. I have been there almost 8 years now, and I started as an associate and was promoted to partner a couple years ago. And over that time, very quickly became exclusively focused on consumer investing. I was fortunate to be involved with some amazing companies that we got to invest in at an early stage. Masterclass is one I'm really close to. I led the diligence for our investments in Robinhood and Uber and Snap. I now sit in the boards of Block Renovation and Stockwell. So I've really gotten to see a lot, probably about 25 different investments over my time there.
Awesome. Kyle, how about you?
I've been with General Catalyst for a little over 2 years. I've had a bit more of a fortuitous path. I started my career as a equity research analyst on Wall Street, covering huge mega cap tech companies, and then switched my career up and went into early stage venture. That was about 10 years ago. I spent 2 years at a firm called Morgan Thaler Ventures, which is now called Canvas Ventures. I work with the folks that are doing early stage internet investing when I got approached by two brothers that ran a big hedge funds based in New York, but were looking to start doing private investing called Coatue Management. This is back in 2012. Really liked what they had to say. I thought they were both, quite smart on what they wanted to do strategically and, their investment prowess. So I jumped on board and helped launch the Coatue private investment funds back, I guess it was now 7 years ago. Spent over 5 years there, focused on mid and late stage internet companies. Helped lead the U.S. piece of that practice, and then joined General Catalyst 2 years ago as part of that expansion you mentioned earlier to kind of help GC focus more on later stage venture and really leverage the relationships they have at the early stage and expand up and do later stage investing.
It's interesting, Coatue's going earlier, GC's going later, and it's happening in a number of different places. What's easier, going earlier or going later? Where's the moat, or like how do we think about this?
They're both really hard, I would say. Multi-stage investing is not for the faint of heart. The characteristics you look for, the type of analysis, and I use quote marks around that at early stage is quite different than you do at later stage. So it's pretty rare the animal that can actually do There are people out there that do it quite well. But to be able to institutionalize it and continue to do it well and remain integrated is incredibly hard to do. Seeing the, General Catalyst, we're trying to do it kind of starting from the early, we call it investing from the inside out. So starting kind of inside the belly of the beast of the venture capital system and invests at later stages. Coatue is taking the opposite approach and moving earlier. There's positives and negatives to both, and I hope we're both successful with it, but it's not easy.
Yeah. Talk a little bit about data and private investing. I know it's something you guys have thought quite a bit about. Where's most exciting to you there? How do you think about that?
Yeah, it's interesting. So when you say data, it's sort of utilizing data sources that are out there and aggregating that up and sort of, I kind of call it the renaissance for private investing opportunity. Mm-hmm. Yeah, I would say there's a lot going on there. And it really kind of started on the hedge fund side of the world, buying access to credit card data, app download data. There's a whole variety of things that are out there that are applicable to private companies. Trying to see what's going on either at a macro level or even a very specific level of companies to see before anybody else knows that this company is starting to scale really quickly, or just have some sort of view on market share and a whole variety of those things, with a good level of visibility from the outside in. I think there have now been a lot of investments made from the venture ecosystem trying to figure out how to do that the right way. I'm not sure it's really been figured out yet. I don't think that there is a renaissance for venture that has been created yet. And a lot of people are moving in that direction. If you think about it, there's sort of a couple benefits you get from it. Let's just use credit card data as an example. You could get visibility to see a company starting to scale before anybody else sees it. That's hard to do, but that could be a nice advantage for you. Where it really helps is diligence. You're looking at a company, you can do a pull of data from the outside on credit cards and really kind of roughly assess of whether what they're telling you is true or not, and use it as sort of some sort of confirmation on that. Or look at competitors and see, Uber's here, Lyft is here, roughly get a sense of what that dynamic looks like. And then it also can be used for marketing as well. And I think that's actually the most impactful we're seeing. Companies investment firms are showing up for their first meeting with companies, having already done a whole bunch of work and saying, we roughly think that you're about this size. Your margin profile probably looks like XYZ. And, end of meeting, here's our term sheet, and being able to move really quickly because they have the comfort ahead of time having done this outside in work. That's kind of been the most impactful thing I've seen so far.
So, Kyle, when I think about being successful in venture, I divide it up into 3 buckets, and I'm sure you've heard this before, but, seeing the deals and getting access to them, picking the deals, and then winning them. And when I heard you talk about how data is applicable, I heard it was applicable in all 3 ways. It lets you see things faster, it helps you do diligence, it helps you win. But how would you force rank where it's most valuable?
I think it helps you get access, but not in the way you probably think.
Yeah.
It doesn't necessarily help you get access sooner than somebody else does, seeing the opportunity sooner. But it actually shows, if you can package it correctly and show that you're smart on the space, that goes a really long way with founders. Shows, beyond the fact that it shows that you care and you've done the work, it shows that you're knowledgeable and you're expert, and you can start your conversation, halfway through where a normal conversation would go, because you don't need to cover the basics with them. And being able to message that to a founder to get access and sit down with them goes a really long way, because, in many cases, they're hoping to learn something from you. And you sort of, the way I call it, it's a reverse pitch. Yeah. You as the investor are pitching the company, showing off your knowledge and the data and all of the work you've done. And it just flips the dynamic and actually is, I think, refreshing for a lot of people running companies.
There are some funds in the public markets like a Renaissance that have built massive businesses leveraging data. So what's different about the public markets that makes it harder to apply data in the private markets? Why hasn't that analogy worked as well, and why are people still trying to figure out versus having mastered it?
I would say a few things. And I don't know as much about what has been successful on the public side, mostly because I read the Jim Simons book, and I still don't fully understand what they were doing there.
Probably
very
purposeful,
secretive.
right?
Yeah, of course, it's purposeful. But I would say sort of a lot of it is around finding correlations to price signal. And in a public market, or I guess I'd call a more liquid market, there's price signal every day. And there's systems that you can draw correlations from that are tracking data with much, much higher frequency and volume that you can draw those correlations from. So, that has a big difference and a big impact on how you can quickly make money. As opposed to the private market, there's a price signal once every 9 months for a private company raising money. It's really hard to draw any sort of correlation there. It's also hard because it's harder to keep a secret here. It's so relationship based. People figure out pretty quickly what you're doing. So if you have access to a data set that others don't, good luck from the word leaking that's out there. And then next thing you know, there's an off-the-shelf product being sold that is basically repackaging what you thought was some sort of an advantage before. It's just a bit harder. Not impossible, but it is definitely something that I think differs pretty substantially what you're seeing with the Renaissance, D.E. Shaws, and those guys of the world.
Yeah, I've spent a lot of time not necessarily making my own data sources, but trying to find data software and data sources that I can purchase or get access to in different ways to help NEA get smarter. And I think what I've found is that while it can be helpful on the margin to benchmark a company's retention or their app store downloads versus another company, typically the network of Silicon Valley moves faster than those data sets allow. A lot of times there's a lag of a month or 2 months between a credit card survey data set that we might want to buy, and by that time someone at the company has already told their advisor, who's already told 4 venture firms. So I've found that it can be helpful, and we certainly are constantly examining and considering which ones to use and are always subscribing to 3 or 4. But I haven't found that it's made such a massive difference that we would shift our entire approach to invest very aggressively and also make investment decisions largely based on that data, which I think firms like Renaissance do.
Yeah, I would say I think you're spot on. I think that the gossip circles work at a much quicker speed to understand what's working and what's not in the venture ecosystem. I would say then that would lead you to believe that having an early stage fund could be a competitive advantage if you're doing later stage investing as well. Because if that's the realization you have, seed, A, B investors, a lot of that is relationship based. It is gossip based, is hearing from these firms or from these operators which companies are starting to scale. That gives you an edge to know sooner.
Yeah. And I think, the point that you made about when I come to a first meeting highly prepared for it and have access to data and helping share information with a founder that they don't have, it's really helpful in the sell process and could certainly help me win a deal that I wouldn't otherwise win because I come across as smarter and more thoughtful and can move faster, and that's great. I think what I haven't seen data do as successfully is have a fund approach a founder and say, hey, I have a data set that's proprietary and an algorithm that said that you're the best company out of 2000 and I ran through the algorithm, so can I lead your Series A? That doesn't really work, right? I think at the end of the day, what founders are looking for is someone who really believes in them and will serve as an advisor, a great board member, at least in the way that venture is structured today. So, and usually the marquee companies do typically fall into that traditional venture pattern. So I think that's one of the big constraints where, because it is illiquid and because of the way that venture is structured, it usually comes down to a founder picking a board member rather than in the public markets where someone can write an algorithm and just say, hey, these are the 15 out of 1,000 companies I screened that I want to invest in as a result of this algorithm that I back tested. I think it's really hard to replicate that.
Yeah. And if that algorithm did exist, I suspect that the characteristics it would look for wouldn't be too different from what great investors look for anyways.
Yeah.
So you just be basically replicating what a lot of people who have been in this business kind of already know already. Some of the basics around what makes a good team, what makes a good early business model. So
yeah, and then one thing I was thinking about on the way over here was if we look at all the sectors that venture capital invests in, software and consumer and hardware oriented business and SMB oriented businesses, are there certain sectors where data can be more applicable than other sectors? Are there certain data sets out there that are easier to leverage and move faster on than others?
Yeah, I would say I think to date, a lot of the advancement folks have made on data in the private tech investing market has been credit card based, which is consumer businesses are using credit cards. B2B companies, there are some instances where something like a Slack gets adopted and, they start paying with their credit card to start, but over time it moves to invoicing and, just the payment mechanism changes. So it tends to be more effective for the consumer segment of the markets. And as you said, there's still lags and all that involved with that data. So it hasn't necessarily proven to be a huge advancement with, finding out sooner necessarily. I would say it's very specific. There might be companies that are related to certain data sets for advertising, things like auto sales data and a whole variety of those that do relate to specific types of companies,
right.
But it tends to be very niche. There is no catch-all, one-size-fits-all type of data that can, really kind of capture all of that.
Yeah.
At least that I have seen yet.
Yeah. I've also heard of a bunch of data strategies that have not necessarily been put into practice, but or have been put into a practice in not a huge way that have been interesting. I've heard a lot of venture capitalists suggest that, maybe we can leverage LinkedIn data where we'll look at a founder and if they've connected with 3 of our competitors, then we'll automatically reach out, or we'll scrape the LinkedIn to look at we'll have a ranking of the jobs that people have had to, get a sense of their engineering team immediately, or we'll scrape GitHub. Have you heard of any other creative ideas like that you think are cool or could work?
Well, I check in every morning and see who Eric Thornberg's following.
Yeah.
And you see, it gives me a real heads up on what the most interesting next generation companies
no doubt.
I mean, Twitter follows and Twitter lists and things that need. I think a lot of people are actually aware of this. And so actually some people explicitly do not LinkedIn connect with companies they're talking to because they don't want to send that signal out. The same thing with Twitter. They will not follow the people that they're the most interested in and maybe create a side account or something like that.
Yeah. For anyone who's mad that I'm not following them.
So those are things out there. And I think that is, potentially impactful. I don't know that has actually worked better than, just hearing about it through the gossip circles or through a network of connections and operators. But yeah, I think that is something that is being used for sure.
Yeah, I think my takeaway, having spent a lot of time evaluating these data sources and actually building processes at NEA of using them and looking at them on a weekly basis is, firstly, just because we have access to a proprietary data source, unless we're making a disciplined habit of building it into our workflow and saying, hey, we're going to look at what's going on in the App Store rankings every single week. We're going to look at this credit card survey data and track this market every single week. It really is very hard to get conviction in a data set and then move on it. So I find that even when we have data sources that we trust and rely on and are really excited about, the amount of human effort that it takes and the amount of discipline it takes from our side is just about the same as if we didn't have it. And if we wanted to approach that sector with that level of time and attention, we probably could find that same information otherwise. And then secondly, I think compared to the public markets where there's a huge set of data, and I think those algorithms can pick a few companies to invest in out of thousands and thousands, or even in the real estate sector where a lot of the assets that people are investing in are more commoditized. I think there's just so much nuance in early stage investing. And by early stage, I mean even Series B, Series C investing, in terms of evaluating team, founders. There's so many differences in business models. There's so many risks that we're trying to evaluate. There's probably 20 or 25 different types of risk that we're thinking about and do so intuitively. I think those are very, very hard to capture by any data set. And like Kyle said, I think most of the data innovation I've seen has been around credit card survey data. And that's so limited compared to all the things that we're thinking about in terms of markets, in terms of founders, that even though we put a lot of investment into it, I would imagine that I'd say that right now it makes maybe a 10% difference in our process. And it certainly doesn't replace the judgment. And I could be, one of the dinosaurs of venture capital here saying, I don't want my judgment outsourced to an algorithm. But I would say that I'd say right now that data allows for maybe a 10%, maybe a 20% improvement if there's a huge investment. And even that requires a tremendous amount of discipline. And ultimately, I think if a team is that disciplined to implement data successfully, there's a lot of things that they do to be successful.
Now, having said all this, there could be somebody out there that we just don't even know about who's using data in some spectacular way and doing really well and finding things before anybody else, investing, and in 10 years will end up being the top one. We just don't know. Yeah. Right. So
my question was, who's done the closest to something interesting here? Is it like Social Capital doing the 8Ball? I guess now Tribe. Is it Signal Fire? Is it, what are you guys doing at General Catalyst? And if we're here 10 years from now talking about sort of the state of venture, is it going to look radically different as it relates to how data is evolved, or does it kind of look like the same?
I would say this doesn't directly answer your question, but the biggest step forward, I think, might be the opportunity to use data to create different forms of financing. So rather than a standard, perfect example, ClearBank, there are things you could be doing with subscription business models and providing working capital, just having a plug into their systems of record. I think we're very early in those things being explored. Because there's so much data being created by companies, you can use that to effectively come up with some sort of rating or a means of underwriting them for different forms of financing. Because It's actually less that you might have a venture firm find a nice data source that takes them to the promised land of finding the next Facebook type investment, and could be more so that a new venture firm pops up providing not just your standard Series A equity check to get their 20%, but some form of debt or something like that that just looks different and feels different than what we've seen before.
Yeah, I mean, I would say that there are certainly funds out there that have marketed using data as a proprietary advantage. I would say that the firms that have been most successful have had some very original idea behind what data they're looking for. And without that original idea, I think it's hard to make data useful. You always have to know what hypothesis you're going after. So the thought that comes to mind, and they haven't done anything in this generation that I'm aware of that leads to super unique data usage. But when I think about Tiger Global and their thesis of, hey, we have Googles and Facebooks here in the US, let's find them all over the world and then use data to find those companies. I think that was a huge return and massively successful, but I would emphasize that it started with that original thesis idea, then data is used to then support it. I think Kyle's right. If we widen the aperture of what investing is and move out of this sort of narrow lane of the venture capital asset class and firms like General Catalyst and NEA that really focus on leading deals, and think more about some of these online businesses, insurance, lending. I think that's where we can see data used in a proprietary way. I would point out, though, that even today with all of the online lending businesses and all of the online insurance businesses, most of them have not started to use a unique data asset and underwrite in a way that's materially different than the way that financial institutions today do. It definitely feels like there is an opportunity to do that. And I imagine that could look very different in 10 years. And frankly, I hope that it does, because I think there's an opportunity to give a lot more people access to capital that aren't finding it through traditional metrics. But I would imagine that it's more likely to penetrate other asset classes like that before it penetrates venture, for some of the reasons we described about before. Transaction costs are high. The data set that we're using, the way we're making decisions is more qualitative. So I think we're going to see innovation in other areas of investing before VC.
Yeah, that makes sense. Shall we transition over to crossover investing? We're seeing sort of hedge funds invest in private invest in public. How do we think about that and where that's going?
Yeah, I'd say you first started. This has been an activity probably for decades in the tech ecosystem, but you've seen sort of an acceleration, probably starting about 7-8 years ago. I think there was a confluence of factors that came up that sort of led a lot of public funds down the road of accessing the private markets. Namely, companies are waiting longer to go public and doing it at a later stage. I don't remember exactly off the top of my head. Was Facebook when it went public 80 billion market cap, something like that in 2012? And, there was a lot of value creation that happened in the private markets that if you were a public fund, you just did not, you just missed that. Versus a generation previously, Amazon went public at 400 market cap. Now it's $1 trillion. A lot of value creation on the public side that you could participate in, and not only a hedge fund, but a mutual funds, pension funds, you name it. That push really started, in earnest in the last decade. And, there were a couple of what I would call buckets of investors. There was the mutual funds, the Fidelities, the Wellingtons of the world. There were the hedge funds, starting with Tiger Global and now Coatue and a whole variety of other smart investors kind of moving in. There's also sort of a variety of what I would call new styles of funds that are popping up as well. So this is something I kind of call them like global funds, and SoftBank kind of falls in that. They're actually their own category to a certain extent, but it falls into that bucket as well. DST as well. So the later stage has gotten much, much more competitive in the last several years. And I think the style of investing seems roughly similar amongst a lot of those players. So, harder to win deals, harder to get better pricing and all of that. It's a trend we're going to continue to see unless for whatever reason companies do want to go public earlier. It's just, you're missing out on a lot of return as a public market investor. You almost in many ways need to have access to those companies.
I think it's really interesting. When I look at IPO prospectuses from the 90s, wow, these companies or some of them could be Series Bs and Series Cs today. And so the level of risk appetite in the public markets changed dramatically. I would probably attribute a lot of it to Sarbanes-Oxley and the increased requirements and cost of going public. And also there was a consolidation of the investment banks. So it was very quickly a much smaller number of companies that were actually deciding to go public. And right around the same time, the internet sector was starting to build these really big businesses. And so there was this very special window of time where these funds like Tiger Global and DST, who understood the internet business model better than most and also recognized this gap in the markets that was created, really were extremely successful investing in some of these companies. Like Kyle said, I think that's getting harder by the day for a number of reasons. One is that almost every fund is getting bigger, and so funds that were traditionally just early stage are now doing late stage. The mutual funds have now also started to invest in that sector, and then more hedge funds have entered that sector, and more funds that are specialized have popped up. So I'd imagine that the amount of funds and capital dedicated to investing in that asset class is probably 3x, 5x, 10x over the last 10 years. And then I'd also say that there's more consolidation in thinking around how to evaluate these businesses. So there's less of an opportunity for someone to say, hey, I'm not as worried about revenue, and I know how to think about the value of a user on Facebook and how they might monetize over time. I feel like lots of people have figured out that sort of logic, and 7 or 8 years ago, that was much less frequent. So I think that market is one that has become quite competitive and quite interesting, but really in a lot of ways much tougher today than say 6 or 7 years ago.
Yeah, there's an interesting thing actually. If you look in the more in the healthcare and sort of the biotech pharma segment of the market, you actually do see a lot more crossover activity. I would argue it's probably ahead of where the tech market is with regards to that, and so you see a lot more public investors going earlier, doing private investments. Companies are going public earlier because there's a lot of guidelines and understanding around going through the FDA process. What's that look like when you go through the different stages? And, the lines are a bit more blurred than I tend to see.
And we actually have a really robust healthcare practice. We see that for them, the IPO is really treated as another financing opportunity, and the level of risk that those investors are taking is very, very different than the level of risk that the typical public tech investor is taking. So a lot of times NEA is an investor in the IPOs of our healthcare companies, much more frequently than is the case on the tech side.
Where's this all going? Let's say we're back here in 10 years reflecting on the previous 10 years. How do you expect this to shake out, or how could it play out relative to the last decade?
Yeah, I think we'll see normal cyclical ups and downs, but the secular trend is just so darn strong in consumer, in enterprise software, in a whole variety of areas going digital, that in 10 years, we're just going to be seeing larger and larger companies get built and more of them, and across the globe as well, not just in the US.
Later or earlier or same?
That's a hard one for me to call, especially with, we're seeing a variety of tools pop up that enable liquidity without really going. So what Carta's doing, and there's a variety of companies sort of creating secondary markets while still remaining private. If those really take holds, there may be situations where you don't need to ever really go public to provide that liquidity. Now, there's some SEC regulation around that, and that still needs to kind of get calcified and figured out over time. But generally speaking, you assume that the right thing happens there. Maybe you see more companies that never go public. But I think for right now, there are benefits to doing it, even outside of providing liquidity for employees, early investors. It gives you a soapbox to get on and talk about your business. It brings credibility when you're selling to your customers. There are a lot of benefits that people tend to overlook, and that will continue to be the case. And so we'll see that keep happening. It seems to me if you follow the current trends that you will see fewer companies accessing the public market relative to the overall universe. But there will still be quite a few that will access.
It's a broader question of, as an industry, should we be encouraging more companies to go public and making that process better? I'm an investor in Long-Term Stock Exchange, for example, is trying to do that. Or should we be offering or encouraging more services like Carta that are trying to bring liquidity and bring some of the benefits of going public so that these companies don't have to?
I would say that it's really hard to answer. I think the best way to think about it is, hey, let's take the emphasis on going public and the IPO and really just think about what does the IPO allow. And it allows for three things. One, it creates more liquid markets. The second is it allows a much more democratic group access to capital. And number three, it creates just better clarity around governance. And I think I would imagine that all three of those things are just going to happen anyways. Markets become more efficient over time for the most part. I do think that particularly tech companies will continue to get the attention of the government, but I think either the private markets will find a solution, such as Eric's long-term stock exchange, or the public markets will find a solution. But I would imagine that increasing visibility into governance, increasing liquidity, and increasing access to capital is probably the broad-term trend that I would bet on.
And this is why some people were excited about crypto.
Yeah, for sure.
You were saying early on, because venture is illiquid, crypto brings liquidity. It allows people to, multiple people to get, it sort of bypasses the regulations that we have around accredited investors, things like that. But some people might counter and say, no, the illiquidity is what makes venture special for a bunch of other reasons. I'm curious if you have a.
Why do you think that people think the illiquidity makes special?
Because it's more reliable capital. People aren't just selling left and right. You can, so long term in that sense, more stability as it relates to building your business. People invested for the long term. If they can just cash out at any time, might employees leave a lot quicker, or founders leave a lot quicker, or venture capitalists take their money out earlier?
Yeah, I think one of the big questions is, should governance and investing be tied together? And I've seen some really smart people in the ecosystem like Elad say, hey, the skill set of being a good board member is very different than the skill set of being an investor. Why don't these things get unbundled over time? I think from my perspective, there's great alignment, and hey, if we own a significant percentage of company, we're going to be the most motivated to make sure that the company operates appropriately. So I very much believe that we take our role as board member really, really seriously at NEA, and we're constantly educating ourselves on how to do that as effectively as possible. But I'd be curious to hear if you guys have a similar position and think that alignment or that tying of a venture capitalist leading around and taking a board seat, like, should that be the way that it works?
As with anything, the answer is probably it depends, right? There are certain circumstances where the right match of a good VC, or in particular a good VC partner with the right company, can provide a lot of value that wouldn't be provided by anybody else out there. The long-term view and enabling a company to take risks, I do believe, is true. And, you mentioned long-term stock exchanges, sort of one of your investment, like, the whole idea and concept is, let's get rid of the short-termism. The quarterly earnings report and having volatile stock moves around that when you're investing for 5 years plus down the road, why does that need to exist in the current format that it does? There's some real wisdom in that, I think. That wisdom is implicit and automatically built into the private equity system and the venture capital system. So, I do think that there is something to that, but there's always circumstances where there are counterexamples to that. And, bootstrap businesses figure it out on their own, and they could have a liquid market and don't have to worry about getting any help from investors, or they've created their own board of advisors, whatever that might be. So I think the short answer is it's not one size fits all, but generally speaking, the venture capital, private equity, the structures and what it enables seems to roughly generally work pretty well. There are bad stories and there are bad circumstances that happen, but it has produced quite a few amazing companies over the course of many generations. And so does it need innovation? Absolutely. Are there incremental improvements that could be brought to it? Sure. But I don't think that wholesale changes and shifts are going to happen overnight that will be successful.
Yeah. I mean, we definitely spend a lot of time thinking about how do we be good board members, and we take the role seriously. And, I think one thing that's unique about NEA, and Kyle was talking about GC being multi-stage. I think actually NEA and GC, in terms of being multi-stage out of one fund, we're actually two of the most similar in terms of fund structure out of anyone. And so I've had the benefit of doing everything from incubations all the way up to pre-IPO investments. And one of the things that we've started to lean towards is taking board seats, even for our seed investments, where I think a lot of the seed market today sort of says, "Oh, we'll worry later about creating a governance structure, and it's too early now." And I think what I've seen, having done quite a few seed investments personally, is that for the companies that we set up a regular cadence of meeting once every 6 weeks, sort of saying, "Hey, this is what we plan to do," and I think just the process of the founder knowing, "Hey, I'm going to have to present to a board or something that acts like a board and put my milestones in front of them." That's just a form of accountability that actually helps motivate them to make sure that they stay on track and allows for a really healthy cadence of feedback. I would sort of say it's more so than us knowing all the answers and having a lot of great ideas on what they should do. It's a lot more like a personal trainer where, hey, just knowing that I've set an appointment to come and check in with you and record our progress. I think that's been extremely valuable, to the point where I've seen companies move, say, on average 50 to 100% faster by having sort of a board or an informal board at the seed stage. And, for any founders out there that are listening, whether or not you choose to take on a formal board member at the seed, I would recommend having some sort of at least informal get together with key advisors or key investors on a pretty regular basis, because I think it's just going to help you. It's going to be like your coach or your personal trainer. And I think that's something that we've seen be really effective.
I'm curious, what is the difference between what makes a great early stage, seed or Series A investor versus what makes a great growth stage investor, say Series B and much later? And I posit that my guess is that sort of growth stage is more about winning than at seed, where I think, for example, I don't have to compete with Bill Gurley on evaluating the best. I mean, it's a bad example because it's the best seed event, Josh Koppelman at evaluating the best marketplaces or evaluating the best companies or winning the best companies. If I see them quicker, if I make a better relationship with them earlier, because there's often undiscovered and one can't see the whole universe of companies. Where at growth, the companies are there, they're obvious. There's a lot more data on them. So it's harder to have a sourcing advantage, and it's harder relative to seed, I guess, at having an evaluation advantage, because there is so much more data on the companies, which makes me think that in competitive markets, it's really just who is the best brand or the best ability to convince the founder that you're going to add more value to the company. Whereas at seed, that might be different because they never even saw the company to begin with. How would you edit my characterization or respond to it?
Oh man, it's a great question. So many thoughts. So I'll just for clarity, I'll sort of share one thought at a time so that you guys have something to react to. So I was talking to, I would characterize him as one of the top 5 or top 10 venture capitalists of all time. And he told me, that, hey, for the early stage, the founder really matters and the market also really, really matters. At the later stage, actually, it's okay to have a founder who's not a 10 out of 10 because they already have built the guts of the business and the market is there. And so at that point, we're really taking a bet on the market. So it's interesting to think, and it might be actually counterintuitive when we think about it. Hey, I'm investing in a Series C company at a multi-$100 million valuation. I've got to have a founder who's good enough to take it public. But, this really talented investor had the opposite view where, hey, it's actually easier at that point to take it from 1 to 100. We actually have a higher bar from the people that we're betting on to go from 0 to 1. So, that's the first. I've got a lot of thoughts about this, but I'll just stop with that and see what you guys think of that.
Yeah. So the way I think about it is, I sort of use this dichotomy of art and science. So at the earliest of stages, it's more of an art. It's like you have good taste in what a team looks like. You have a rough sense of how big the market is. But as you said, there's no numbers. A lot of times they're not generating revenue. There is a product. So there's taste around product that matters quite a bit. And, that's the seed and the A stage. That's really kind of what you're looking for. And there's some people who are just great at that. As you get to later stage, there's more science. There's needing to know what the right analysis to do is, how to put that into a broader context of market sizes and TAMs, competitive dynamics and all that. But that art never goes away. That art's always there. So if you do have a good sense of, what a good team, well-functioning team looks like, or what a lot of great late-stage investors do is they know early-stage investors who have that sense and they get their perspective on that company. That gives you, I think, a pretty nice advantage relative to somebody coming in cold and just looks at the cold numbers and makes an assessment based off of that. So people who can kind of figure out how to bridge that gap going from an early stage to a late stage company, I think have a bit of an advantage on that. It is competitive at the later stage. It's competitive at every stage these days. There's a lot of capital out there. Finding a differentiated value add is tough. All money's green, and a lot of people tend to think that, Series C or later, it's all about getting the highest price. I don't think that's necessarily true. I do think that there are certain investors that can bring a good strategic perspective, help bridge the gap to going public, find good advisors or board members, board composition. Finding a good CFO to get you positioned correctly is a really difficult task right now. There's just not a lot of talented people out there. There's a scarcity of it. Anybody that can help along those lines. So it's sort of like the key things that you help with at the early stage kind of get amplified a little bit at the later stage. And if you're good at that, you're good at that. And you can add value. Now, proving that in a competitive process can be hard sometimes. But over time, you build brand reputations or build for a reason. And it's proving over and over again a pattern of being able to help companies get to the next level and succeed.
I would say that the specialization at each stage is helpful, and being someone who has invested across many stages, I see how different it can be to invest in a Series C company versus a seed stage company. I remember, one company that we helped incubate, the CEO and founder is Brighton Shang, brilliant person. And he's asking, hey, how do I hire my first engineer? And I'm sitting there being like, okay, I know a lot about how to analyze your business, but I've never actually thought about what are those specific qualities, And so it's a good example of, hey, someone who is doing that again and again and again will just have experience and a network that is more helpful to hiring those first 10 employees. And then Kyle pointed out a bunch of things that a lot of seed stage investors, not because they're not smart enough or anything like that, just because of the reps and what their experience is with, there's all these different elements of a company that need to be optimized at sort of that Series C, Series D stage, knowing what the financials should look like and helping build the budget with them, helping them build up a leadership team, usually through the process of many retained searches, and knowing what a great VP who's had 15 years of experience building product or engineering organizations looks like. Same thing for the C-suite level. And those are all skills that someone can be better at as well. So I think any stage that we're investing at, there's a lot of specifics to that stage that it takes a lot of reps to get expertise in it, and then also build a network around to help. So I think in addition to just the difficulty, there's also a specific skill set that needs to be built over time.
Yeah, I had a conversation with the CEO of a company. It's a name we would all know, multi-billion-dollar valuation, still private. He made a comment to me. He goes, when I was raising my Series A, every firm I met with, had the resources, had the services built to help me go from 2 to 200 employees. Hiring, thinking about my organizational structure, helping me acquire customers, whatever it is, you name it. The firms could help there. But he said once I got from the 200 to 2,000 phase, that really disappeared. And it's something I took to heart and sort of thought a lot about what we can do at General Catalyst to improve that. So I'm thinking through different services around providing CFO advisory services. The finance function is the lifeblood of a later stage company. Mm-hmm. How do you do that and make that best in class? There's a real benefit to that for them, because it matters much less when you have 20 people. It matters a lot when you've got 2,000.
Yeah. I think about it in a little bit different way. Whereas it seems to me that the later stage you go as an investor, the more it becomes an efficient market, and the more it becomes something more like poker where people are playing the same game. Whereas early stage, and I should say my experience was really shaped by my experience at Product Hunt, where I just felt like the game was rigged. Or the earlier you go, the more you can rig the game. And what I mean by rigged was just having been at Product Hunt, I now had all this access to companies before other people were seeing them, because they would say, hey, we're going to launch in a few months. And it was a programmatic way I could be lazy and still get this inbound in a sort of scalable way relative to individuals trying to do it. And so one on the sourcing side, and then two on the anyone who was building a social thing or valued or had startups as their customer, really valued product on as a distribution channel. And so I felt like that tool was a unfair advantage for me in a way that allowed the game to be rigged a little bit. And so I was obsessed with, wow, how can I, as someone who struggled in school my whole life, I was like, I don't want to be in a game where we're all playing the same thing. I want to be in a game where it's rigged to get to it so that my execution my outcome doesn't depend solely on my execution, where I just have this unfair advantage. And so I was like, how can I build other tools and products and communities and services that give me more advantages there? And to me, it seems to go away as it gets further up because there's less sourcing advantage and the people are just way better. I'm curious if any reactions to that.
I think that concept of rigging the game or creating an advantage is sort of what you're seeing happen in the market right now. People are sort of trying to find their way through the maze of like, how could we recreate what Product Hunt had or Y Combinator has at the earliest of stages?
That's, for example, they're rigging the game.
Yeah. They've done it a spectacular. It's an amazing program. I would recommend anybody starting a company to go and go through that.
I wouldn't go that far, but they're they've won. It's great.
And so, nobody knows yet what that next step is. Just like 12 years ago, Y Combinator was going, but, kind of hadn't reached the critical mass that it has today. So it could be a data advantage. It could be people building out some sort of a service or finding a new creative, or it could be who rigged the game at the late stage was SoftBank with Vision Fund 1. They were operating on a scale of capital that nobody else could compete with. And they could do it so quickly that they were playing a different game than everybody else. Now, whether that was successful or not, it's another question. But
yeah, I mean, I would say that there have been very unique ideas and very unique investing strategies at all stages. And there's some, you could look at some of the most successful strategies at the growth stage, and it looks like the game is rigged there too. Being, if you look at TA and TCV and Insight 2 decades ago, and they were investing in profitable companies, growing really quickly, and other firms were scared off because they were technology oriented. That looked like a rigged game. When you look at
can you see it at A?
Sorry?
Is the middle where it's hard to rig that? Benchmarks go. I mean, there's so many. Is that where it's at its most fair, and that's where it's at most.
I think that the way I would categorize it is that, certainly we see a lot of funds competing at the seed and pre-seed stage, and more incubators being built. And I think there's, well over 1,000 seed funds now. I think there's hundreds of seed funds getting created every year. At least that was true a couple years ago. And we're seeing a lot of capital enter that growth stage market. And not to give an ad for General Catalyst and NEA, but I think there's a pretty small group of funds who have had the experience of lots and lots of IPOs and lots of successful companies, and do take board seats and really help build companies. There is really a very specific playbook that is understood by a few people who've been there and done it before, both on the investor side and also on the company side, which is what makes a few firms seem to have magic, and what makes Silicon Valley magic is that there are people who just have these playbooks in their heads that are very difficult to replicate. So I would definitely say that, Series A, Series B, not to say that when we do invest in other stages that we aren't really excited about, and there aren't a lot of opportunities there too. But that's certainly sort of a rarefied air where there's, maybe a dozen to 2 dozen funds that really have a competitive advantage. And I'd put both General Catalyst and NEA in that category.
Yeah, it tends to start a lot of times at the later stage with sort of an insight into where the market's heading or what's going on around the globe. And so I would say even today, there is a nice advantage from having global visibility. There's great companies being created everywhere around the world. If you know what's happening in China, that gives you an advantage in the US and vice versa. And there's still a very small subset of firms that have that visibility, access, knowledge of both those ecosystems. But that's something that over time will continue to deteriorate as more and more firms figure that out and start doing cross-border investing in a more meaningful way. So, it tends to be ephemeral. It's hard to build a structural advantage at the later stage.
Yeah. It's interesting. But I guess what's fortunate is that brand can last for so long in venture. Like it's once you have something like NEA, General Catalyst, it's really hard to lose it. And it takes, like, even if you mess up tremendously, it takes like a decade plus, and you can get it back. I'm curious. So if we look at some of the venture firms that have the biggest AUM, NEA, General Catalyst, Andreessen, I don't know, Founders Fund, Sequoia. I don't know if there's any other names you want to throw in the hat. In terms of how you guys differentiate on a strategy level, you mentioned you guys are very similar, but there are others who have different approaches. And I believe GC is doing various different types of structures and even asset classes. Maybe I know Social Capital was doing a lot of real estate, a hedge fund, the SPAC or something like. Ali Hamed came on the podcast, my friend, and he says, the future of venture is going to look more like, a franchise model across different asset classes. And you're with Andreessen, you're seeing a little bit crypto, bio, Social Capital, of course, doing the experiments as I just mentioned. How do you see that playing out and evaluate the different models or the different ways you can go really big?
Yeah, I mean, what I would say is that I think from the outside, a lot of people will look at the NEA website and say, oh, hey, that looks like a lot of people. This looks like this refined institution with all these strategies, and I would say that on the inside, it really feels like I would say that it really does come down to those individuals and we're all sort of pursuing our intuition on what to pursue. The markets are moving too quickly, both at the ideas that founders are generating and also just the dynamics of the world are changing too fast for any one strategy to work in a static way for a really long time. So we're all following our intuition. And, Kyle and I both have talked about how we're sort of shifting our attention and learning about different areas, probably on a quarter by quarter basis. And so when it comes to a founder, in the situations where we're competing with another firm that's of an equally high caliber, I think it really comes down to the connection between that partner and that founder. And most of the time, I think founders find that they'd be lucky to have more than one person who just truly understands their business and is passionate about it. And I think at the end of the day, when we look at the surveys, when we talk to founders about it, all the services aside, all the strategies aside, it just comes down to, does this person believe in me? Do they have conviction in my business? Do they understand it? And that's sort of number one almost always. Yeah. And then, I think if you are beneficial enough to have two people who are ultra successful, who are equally passionate about your business, then you can compare, all right, how does the talent team stack up and how does their international team stack up?
Is NEA going to have a real estate, practice or a hedge fund practice or a separate crypto fund or bio? Like, how do we think about these types of decisions?
Yeah, the way that we think about it at GC is the core of the business has always been and always will be the early stage venture practice. And we have a variety of different approaches within that. We hatch companies. We have Rough Draft Ventures, which invests in university students. Yeah, we have seed investing in traditional A and B, Boston, New York, all the major ecosystems, Silicon Valley. That's always going to be the core. Anything we do, whether it's adding a new asset class, fund type, whatever it is, needs to be related to using that as sort of a core advantage, or sort of think of it just as an offshoot of a branch coming out of that core. Otherwise, it doesn't make sense. We're not doing this just for the sake of trying to get more assets or anything along those lines. This is really about using what we have and what is working really well and building off of it. And so if we can serve an entrepreneur better by providing debt financing or whatever their needs might be, and we can do it in-house because we're already invested in the equity, we know the firm, we know the company, we know the management team, so be it. That would be great. That's a nice positive thing for both sides. But if that is not something that ends up being, helpful, then we won't do it. I would say that there's certain circumstances where some of these real estate platforms, if you can bring both large pools of capital for debt financing alongside the equity, that kind of becomes a self-fulfilling prophecy, because that's sort of one of the key drivers for being able to scale that business quickly. You can actually make a lot of money off of the equity if you're also providing the debt. So there's certain circumstances like that. And as you see technology seep itself into other industries over time, you'll probably see a bit more of that. But, whether it's going to be one monolithic funds that can provide all of that, that's a really complex organizational issue. It's going to be really hard.
There was this big conversation about debt this past week. I don't know if you guys saw on Twitter. Alex Danko had this blog post about venture debt. Do you guys follow this at all? Is that a viable option? Is that something that's going to become a lot more popular for founders?
I kind of referenced it a little bit earlier in the conversation that because there's so much data now coming off of these companies, you can kind of underwrite them in a unique way. I would actually say unequivocally, yes, you will see more of that happening. Whether it becomes a huge thing and starts taking share away from doing equity financings, I think it's too early for us to tell. Because a lot of these models are still very, very early trying to get figured out.
I think another thing, these things and things like Clearbank are bringing up is basically the question, what's the role for venture capital? What is the proper scope for what venture should be doing? Should it be just taking technological risk? Should it be as expansive as it's been to date? Do you have a point of view?
Ultimately, venture capital describes a very, very wide array of investing strategies. If we look at NEA's healthcare venture capital practice and our NEA tech practice as an example, there's a lot of differences in the way that we evaluate companies and the way that we structure investments and what we look for. So I think venture capital is already super broad. One of the challenging things about venture capital over the last decade is so many new business models have been created. Sometimes it can be really challenging for us to figure out, hey, what is the right framework for understanding what's the appropriate amount of capital to provide? What should the market look like? And so a lot of times we'll sort of take, in software, we invested, 20 million in a company that's doing X million in revenue. Well, now this company in a different category is also doing X million in revenue. Should we give them the same amount of money? And I think that's hard because every category has a different loss ratio in terms of the number of companies that succeed and fail, a different, ultimate potential in terms of what the company's size can be, and a different capital intensity to it. And I think those are sort of the factors that all can be sort of determined by the structures that VCs typically invest in terms of the percentage of the company they take and how preferences work. So I think it can all be solved within venture capital. But I would say that the product for consumer internet or e-commerce, you could think of it as an extremely different product than even for enterprise software and certainly for healthcare. So I think, venture capital, very wide aperture, but let's recognize that we're already sort of fitting different products into the same sort of structures.
Yeah. This is near and dear to my heart because I focus a bit more at kind of the mid and later stages. But what are the risks you're taking if you're doing a Series C or a D versus an A or B? I mean, there's no business model risk at that point. It's really more around, is the market size large enough for this company to continue to scale and scale and scale? If it's an enterprise software company, it's kind of a formula at that point. It's for every dollar in, for every salesperson we hire, we know we're going to get this level of output. A formula like that sounds to me like that could be fixed by something like a merchant cash advance or some sort of structure that sounds a bit like that because of the reliability of it or the expected reliability. So we could see things like that start to pop up as people start to think, maybe equity financing for my Series C doesn't make sense. Maybe I have to make the trade-off of growing a little bit slower, but if I maintain more ownership as the CEO, I'll be happier with that.
So I think what you just heard is, no, there's nothing that venture capitalists shouldn't invest in. We want the latitude to invest in everything.
So compare Coatue and General Catalyst a little bit. Will they, you mentioned they're doing it because it's the core, both of them. So what is the core that General Catalyst is leveraging to go late stage, and what was the core that Coatue is leveraging to go early stage? And do they become competitors at some point? And not those two firms specifically, but just broader, like hedge funds going early, and venture capital firms going late?
I would say we're not seeing it happen in a broader sense yet.
But it might happen.
Possibly. If it ends up being a rousing success for Coatue, absolutely. I mean, you will have people start to try and utilize the same strategy. The core at GC we're a connected firm. It's the relationships that you get from the early stage practice that sort of feed itself up into the other parts of our business that we've been building over time. And that's sort of what we value. That's what we care a lot about. And that's what we think could give us an advantage for later stage companies as well. at Coatue and firms like that, they're very good at relationships as well. It's just that the initial starting point for the relationship has historically been much later. I sort of always say this, you go to a CEO's wedding, you'll see the seed investors there right in the front row or as a part of the wedding party, and the Series C investor doesn't even get invited. Right? It's just a different relationship you have by the time a company starts to scale. And, we can argue whether that's good or bad. It's just, it is what it is. And so, being able to move earlier and build the stronger earlier relationships and being alongside them when you're taking the most risk for that organization could be an advantage for you over time.
Yeah. I would say that, at NEA, where we have the same team effectively both do early and late, we see some pretty unique advantages on both sides. With these early stage companies, we have the credibility to say, hey, we have a pretty good sense of what the next couple of stages of investors are looking for, which is why maybe you're not thinking about prioritizing your financial infrastructure, but trust us, it's important. And so it allows us to have a perspective that perhaps that company wouldn't have otherwise at such an early stage. And then at the late stage, one of the most interesting things about this last decade is companies are getting big faster than ever before. And so we're putting $500 million, billion-dollar valuations on companies that are sometimes only 2 or 3 years old. And so, and no matter what the valuation, is on a company, sure, maybe, the venture capital community is valuing them like a public company. They're still a 2-year-old company. And so, NEA versus perhaps a traditional growth investor who is very aware that typically they invest in 10-year-old companies or companies that are just about to go public, that there's a lot more infrastructure to be built and a lot of different things can go wrong. So a lot of times what we find in these 2-year-old companies is that their market is changing, their business is changing, their team is changing super, super fast. And that's where our lens as early stage investors is really helpful. It's like, hey guys, I get it. Yeah, I know that your company is valued a lot right now, and so the expectations are super high, but we're still patient. We still know that company building is really hard, and you're only a couple years into it, and there's a lot to learn. There's a lot of team building to do. So I personally have seen a lot of benefit in having that aperture of both early and late.
I'm still waiting for that unicorn seed round to happen. It's coming. You're going to see the billion valuation on a seed round. I got to imagine that we'll see it eventually.
ICOs had that sort of craziness to it. It is interesting because, NEA and General Catalyst are like platforms, franchises effectively that have kept quality high across the stack for many years. There's a number of other great firms that have chosen not to go as big and stay more traditional. That's, Benchmark maybe, First Round, USV. You could probably name a number that have sort of stuck to their knitting. I mean, they've expanded, but stuck to their knitting or aren't as going as big, I have air quotes, as your respective firms. I think GC, relatively recently, I feel like has even in the last 5 years, like significantly the ambitions. I'm curious if you think that, or how do you think about that between what separates the firms that choose to go big besides the firms that choose to go small? And I'm curious if a firm like Kleiner, which is sort of known for having the top spot brand wise and maybe falling off for a few years, and now is on the upsurge again. But I'm actually curious, did they, for example, if they'd gone as big as General Catalyst, maybe their late stage practice might have taken off in a way that maybe Coatue's early stage venture practice takes off, and it sort of diversifies a little bit so that if their early stage fell off, they could diversify, rest on their laurels of the late stage success. But I actually wonder if they credit their downfall, in air quotes, to diversifying too much. They had a late stage practice, they had a healthcare practice, et cetera. It's laughing. Take over.
I'm laughing because I'm trying to figure out how I'm going to give an answer while making no comment on any other venture capital firm. Please. Yeah. I mean, so what I would say is, especially at NEA, where lots of people view us as this, amazing institution, this massive platform, 4 decades old. I think it's really important to remember that there's still just a very few leaders at any of these places. And me as a pretty young investor at NEA, I still have a great relationship with Dick Kramlich, who's one of our founders, still have a great relationship with Peter Barris, who's our former managing general partner. And I bring up those names because at the end of the day, the DNA is set by just a few leaders of any of these platforms. And the decision to go bigger or go smaller or shift into different strategies really comes down to sort of the leaders of a firm, those individuals, those humans expressing themselves as investors, more than anything else. I don't think that there are many firms who look at a whiteboard and say, all right, mathematically, how do we sort of optimize income or impact? I think what we see is that the best investors view investing as an expression of themselves and a way to express their creativity, which is why we've seen so many firms unfold in different ways.
Yeah, I'd say that the way Amit put it is probably the best, and that it comes down to the leaders of the firm use the word ambition, like what their ambitions are and how they want to express their investments, approaches, and strategies, and what they think is best longer term for the firm itself as well, in terms of continuing to build and compound upon the brands that they spent decades building over time. So I would say that's probably the primary driving factor, but the history of firms having done it successfully is pretty thin, right? It's kind of where it's more frontier territory at this point in time. And so you're taking risk in doing it. There's a lot of organizational building that needs to happen. You need to start thinking about your processes different, formalizing things, adding bureaucracy is sort of a natural part of that. And a lot of early stage partnerships, they do this because they don't like bureaucracy. So there's a lot of things you need to be comfortable with as you evolve your firm and change it. But whoever can figure out how to do it correctly, I think will have a large platform that will have advantages that will continue to compound for decades after this. Yeah. So it's worth taking a shot.
And I think really what it comes down to is, are the founders and senior leaders of a VC firm excited to mentor and build their own teams and groom those teams? And Kyle and I both started in this industry quite young, and I can't speak for Kyle, but I certainly benefited from an attitude within NEA of, hey, we really want to expose you to a lot to help you grow from within. I think that's a skill set in and of itself. We talked about skill sets of different stages, but there's also specific skill sets of keeping a firm smaller or bigger. Certainly NEA has chosen to be bigger. And one of the things that we're best at is grooming talent. Rick Yang is our most recent general partner, started as an associate in 2007. And I take a lot of pride in our associate program now. And because Rick and others like myself have gone all the way from associate to partner, we put a lot of pride into investing in that next generation as well. So that's one of the things that I think is really special about NEA, and one of the things I'm most proud of is it's not just a place where we invest in founders, we also invest in our own investing team.
Yeah, that's awesome. And so let's pretend we're having this conversation in 30-30, and I'm asking you about your how
30 or 2030?
2030. You can see where my brain is. 2030 is NEA and General Catalyst more or less the same, but just much bigger, or is it some radically different like offerings or institutions? Or because I'm not an expert in NEA, but I feel like for NEA 2020 to 2010, is it been just following a sort of a path and just growing sort of appropriately versus like radically divergent paths?
I think we have a lot of really interesting conversations internally about what the future should look like. And I think there's a certain quality of great leaders of a VC firm and great founders where they're always constantly responding to markets. So it's a really hard question to answer, because I think there's always a chance that any organization that's really skilled will pivot really quickly. And we certainly talk all the time about how do we improve our business and talk about lots of interesting ideas, but it's just really hard to say what the future is going to look like.
I'm laughing a little bit because that is almost word for word the question I always ask companies when I'm in my first meeting with their CEO. So it's hit me in the right spot. When I typically ask that question, what I'm trying to get at is sort of like, what's the next act that you can't do today, but once you've sort of nailed what you're doing today, you can sort of build on top of, and that unlocks new potential for your business. I think for us, there's a lot of dimensions that we can move into. And as long as we nail what we're doing today, there's a dimension of international moving into other countries. Because I mentioned this earlier, there's brilliant companies being built everywhere around the globe. It's moving into other asset classes. It's moving into later stages, even beyond what we're currently doing today. All those are fair game. Those aren't on the current roadmap, but who knows, right? Like, as long as you continue to maintain that core relationship and that core advantage over time, these are possibilities. It's just organizationally really hard. It's complex. It's going to require a lot of time and effort, and probably a lot of false starts too. So we'll see.
Yeah. I want to transition a little bit into a topic, Amit, that you've been thinking quite a bit about in terms from an investing perspective is the food sector.
Yeah.
So why don't you talk about your evolution and how you got excited about it? Where is the white space? Where are you looking at? What's your request for startups?
Yeah, for sure. I mean, I'd say that one of the really interesting things about being a consumer investor over the last 8 years is how much more physical the whole category has gotten, and food has been really a core part of that. I think the last cycle of companies, Facebook, Google, Twitter, et cetera, were very, very lightweight software products. And I think it's really exciting that founders and are creating now not just to attack software screens, either a mobile screen or desktop screen, but just the entire world. And that's super, super cool. And food is a great example of that. What I think is so amazing is, I remember, meeting with one of the very first meal delivery companies back in, 2012 and thinking, wow, this is such an interesting category and, problem. And, it's such a big market. The repeat rate is so high. So much is being spent on this category. There's a lot of ability to do things here, and the way that we eat could change quite dramatically. Since then, I would sort of make a couple observations. The first is that food and investing in food is not just one category. There's every layer of the value stack, literally everything from a seed planted into the ground to like the fork being stuffed into your mouth is changing. So everything from alternative proteins to the way that the food is constructed to the way that it's delivered to you. There's innovation up and down that value stack. And I think we could have an interesting conversation just about where within food we would want to invest. The second thing I would say is that if we actually look at the dollars invested in food versus the dollars out, it's been a much riskier category than, say, enterprise software, where the total dollars that are spent on enterprise software is less than the dollars invested in food, but the returns for investors and the market caps have been greater. And I think one of the things that I would emphasize both for investors and founders is, hey, when we're thinking about market size, a lot of times everyone looks at revenue and points to revenue as and the sum of revenues in the space as the market. But I think the more appropriate thing to do, particularly in a market like this where the margins are a little bit lower, is to look at the net income market size, how much is actually being accumulated in profit for any category. So not what are restaurants making on the top line, but what are restaurants making in profit after all their costs, and also looking at the market size from a market cap or enterprise value perspective. So if you're thinking about opening up a quick service restaurant, don't look at the billions spent at quick service restaurants, look at the market cap of all the public quick service restaurants. And I think that'll give us a better sense of the scale that we're talking about, because I think that when I look at so many investors who've invested in companies in this, it's actually been 3 or 4 cycles now over the last 7 or 8 years investing in food. I think a lot of those things might get missed a little bit. But it's a very interesting category. If I was going to sort of pick a couple areas that are interesting, one is just thinking about convenience. And I think there's a lot of money spent on convenience. And then the other is content. So actually the quality of the food itself, which I think has components of it that are just about flavor and tastiness. And then there's another that's got sort of a nutritional component to it as well. But I think, content and convenience are two ways I would think about, the way we think about food.
You must be a real glutton for punishment. You think about food all the time and you're putting yourself through intermittent fasting.
Yeah. Yeah.
So food itself as a category, I mean, listen, we all eat. right? It is a large profit pool globally. There is a lot of moving pieces right now of things changing. And I think fundamentally what's driving a lot of that is a shift in consumer preferences. So people wanting convenience, people wanting healthy, people wanting it available much more widely. Simplest way to think about it is now I can go home and sit on my couch and fire up DoorDash and order whatever I want and have it delivered right to my door within an hour. It's kind of an amazing product. The thing that hasn't quite yet been figured out on that front is how to do that with a significant amount of profitability without passing that cost on to the consumer. At the end of the day, it would require innovation around transportation and a whole variety of things that are a bit what I would call lagging at this point. And we talk about drone delivery, sort of taking the labor cost out of food, probably at least, 10 years away from that actually becoming a reality. I've actually focused a lot of my time around what I would sort of call full stack opportunities. So people trying to reinvent the full experience, whether it's an online grocery or sort of, I think what cloud kitchens are doing is pretty interesting as well, that are sort of being more holistic about pulling costs out of the system so that you can compete effectively with a food system that has spent, decades and decades since post World War II, building itself out and doing it the most cost effective way possible.
Does this mean you're bearish on companies like Instacart or Rappi or DoorDash, or how do you evaluate them or see the?
I would say from a product perspective, those are great companies. And I use Instacart, DoorDash, Uber Eats, you name it, on a pretty regular basis. I do worry about the ability to access a more cost-sensitive consumer over time because they are adding a lot of cost to the overall system. Would I say that I'm bearish on them? No, all those are growing really, really quickly. They're proving customer demand. Unit economics, from what I understand, are improving across the board. And I have not invested in it.
Yeah. I guess what would you need to believe to have wanted to invest? Or
I think what we need to believe is an ability to get those goods to the end consumer in a more efficient, cost-effective way than they currently are today. And I was always, when Uber Eats launched, was this 5 years ago, 4 years ago, I always felt like they had an advantage to do something that some of the other platforms don't around stacking, just because they had so much availability of drivers on the road and so much demand on their platform that, one driver could go and do 5 drop-offs within an hour, and they could use that labor more efficiently, which lowers the cost for any individual of those deliveries. I'm not sure if that's, proving itself out at this point, but there are people rebuilding models, to GoPuff as an example, that has a bit of a different delivery model and can get much more utilization out of the delivery people. Now, they're not doing perishable foods. They're doing some, more convenience store type items, but they're rebuilding the 7-Eleven experience for an online world from the bottom up, and they're seeing success doing that.
Yeah, I mean, I'd say that, speaking of GoPuff, I think I have an investment in a company called Stockwell, which is doing something similar where the food is on premises. And so, one of the arguments that we make, or one of the reasons we were excited to invest is, hey, every customer is certainly saying, I want it faster and I deserve it faster. And that's not going to change. I think what we got excited about with Stockwell is, well, actually, if it's already there, then that's significantly faster than waiting 30 minutes to an hour for food or product to consume to arrive. And it's actually, from a unit economic perspective, more viable as well. So that's what we thought was interesting about that one particular investment. But, Kyle, what I would say, what I would like to see, and I think what is now being forced upon us by the public markets is, are we looking at the right metrics when we're investing in this food category? And I think one of the things that happened, 7 or 8 years ago when this food category started coming up was venture capitalists would apply the model they were using for software investing to food and said, hey, high growth. And if you're burning a lot of money, you don't really need to worry
10
about
times
it.
Revenue.
Right, exactly.
now 20 times.
And I think the reality is that, right, yeah, the valuations on the software side have only gone higher. But I think, given the margin profile and given the way that these companies are so physical, we've needed to have different frameworks. And so for my companies that have a physical component to them, Block Renovation and Stockwell, in addition to looking at traditional metrics, we actually look at return on invested capital. We look at the internal rate of return on projects. We look at the net present value of projects that we do. And I think that we're just getting started with founders attacking the physical world world. And I think we're going to need materially different frameworks than were used 7 or 8 years ago for understanding what those companies should be aiming for. And that's been one of the challenges, is that thinking about what the goalposts are. I don't think we as an investment community have actually quite figured that out. And I don't think the founders have figured that out yet. And it's a bit of a conversation between the two of us. But I think we're going to see that become better, and we will see some excellent physically oriented businesses that crush it in the public markets and become amazing companies. But I think we need to do a bit of a reorientation right now.
Yeah. My guests today have been Amit Mukherjee from NEA and Kyle Doherty of General Catalyst. Guys, thank you so much for coming to the podcast.
Thank you for having us. It was great.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.